Hello, this is Michael Harris from Price Action Lab blog. This is the second video in a three-part series about using DLPAL DQ software to identify price action anomalies and outliers in price action. If you haven't watched the first video, please do that before watching this video. After we created a scan workspace, the program generated the results here. It generated 8 price action anomalies, potential price action anomalies, 5 long and 3 short. 1 long for the diamonds, QQQ, 2 long or 3 long for the XLP, consumer staples, another long for utilities ETF, 3 short, 1 for the Japan ETF, 1 for gold ETF, and 1 for the energy ETF. Now you see here the P is the win rate of the anomalies, and for QQQ is 71.43. P1 is the win rate for the exit on next bar, and you see here that these 2 short anomalies, they have a very high P1 win rate. This is a very interesting metric we use. The trades are listed here. QQQ has 63 trades in the history of the ETF. CL is the number of consecutive losers. Here is the signal, long or short, the target and stop pair that corresponds to this particular instance of anomaly. C is refers to the percentage for the stop and target, and last date, the first day, shows the first date and the last date of the history of the ETFs. Now, as you see, the trades are relatively low, small number here, and we don't know whether these anomalies are statistically significant or they are random. So what we will do is perform a portfolio back test. We will test all anomalies in all the data, each one, in all 32 data. This program has a very powerful portfolio backtest engine that will determine key metrics of significance for these anomalies. You see here for the diamonds, the profit factor of the portfolio is 1.4. The expectation is of the portfolio is 0.2990, and the win rate, that means the percentage of ETFs that generated a positive result, is 62.50. Usually for long anomalies we want more than 1.5 for the portfolio profit factor and more than 70% win rate, but for short anomalies a profit factor of 1 may be enough, because these are rare. So we see here that for XLE we got 1 for the portfolio profit factor, a little bit higher than 1, and we have a win rate about 65.63%. Maybe then this is a statistically significant anomaly. We can also test the robustness. By that we mean we vary the target and stop loss level, which was 1.5 in this particular case, from 0.19 to 1.88. We keep the ratio the same, and we determine the win rate as a function of the stop loss and profit target pair, and also the expectation. We see that these are increasing functions, and this is a good result. The robustness index we calculate is 84.21. Usually we like this to be higher than 90, but for a short anomaly this is usually good, and we believe that this anomaly may have potential. Now in the next video we will look at the analysis of the returns of these potential anomalies, and also at some other options and features of the program.